but of all the data that came out this week, I think this is the most interesting number. The Bank of Canada is suggesting that Canadians are about to feel the pain of higher interest rates, stating that a steep increase in interest rates is causing financial stress for borrowers across Canada, especially those with variable rate mortgages and fixed payments. And in a new research report studying variable rate mortgages and the trigger rates, they are suggesting that up to half of mortgages taken since mid-2021 are variable rate mortgages, accounting for 670,000 mortgages across Canada. And of those variable rate mortgages, more than half of them have now hit the trigger rate, meaning payments are about to increase substantially for many borrowers. Now, the irony here is they're suggesting that the reason people took variable rate mortgages over fixed rate mortgages was because they were significantly cheaper during the pandemic, but this is not the case. In fact, I'm going to show you in a minute here exactly why people took variable rate mortgages and also why bankers and mortgage brokers and people in the financial industry were so comfortable with their clients making those decisions. But before we get into it, my name's Nolan Matthias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button and hit the like button so more people like you can see this video. Okay, so lots of interesting news coming out of the Bank of Canada today. Senior Deputy Governor of the Bank of Canada, Caroly Rogers, delivered a speech today that talked about the greater economy and specifically variable rate mortgages. And at the same time, simultaneously, the Bank of Canada put out a research paper on variable rate mortgages and trigger rates. Now, there's a bunch of really interesting stuff that came out of this speech and the report. I'm going to show you the headlines first. This one being from BNN Bloomberg. Bank of Canada says financial system to weather rate hike risks. They talk a little bit about jobs. In fact, they go on to say that there's really good reason to believe that the economic downturn isn't going to be that bad. Now, this is going to lead into a piece in a second here where I'm going to talk about the extraordinary forward guidance that was provided by the Bank of Canada with respect to interest rates over the last couple of years and just how wrong it was. But here's the thing. At this point, how much credence can we put into the Bank of Canada saying, you know what, you don't have to worry about jobs, you don't have to worry about an economic downturn, when over the last couple of years, they told us you could borrow at low interest rates and not have to worry about interest rates increasing for a very, very, very long time. I'm going to show you that clip in a second. But I want to move on to the second headline here, and that's this one. Some recent homebuyers will find rate hikes painful as mortgages go up, according to the Bank of Canada. And this is very interesting because they put out a variable rate mortgage report, a piece of research that talks about variable rate mortgages, the trigger rate, and how many people they expect to have hit the trigger rate and where things are going to go in the future here. And I want to point out this paragraph early on. I want to read this to you. For most of 2021 and into early 2022, variable mortgage rates were substantially lower than fixed mortgage rates. This isn't true. As a result, many borrowers opted for a variable rate mortgage. This isn't why they opted for a variable rate mortgage. These types of mortgages now account for about 1/3 of total outstanding mortgage debt, up from about 20% at the end of 2019. Now, I'm guessing that you're wondering how I can be so sure that variable rate mortgages were not substantially lower than fixed rate mortgages in 2021 and 2022. Well, one, I'm in the industry. I sell mortgages for a living, so we know this not to be true. But in the Bank of Canada's own statistics package that they released with this report, it shows variable versus fixed rates, and it shows that they were very, very, very much the same throughout 2021 and 2022. In fact, they didn't diverge until basically February of this year when the Bank of Canada started increasing interest rates. So if it wasn't because interest rates were substantially lower on variable rate mortgages than they were on fixed, then why were people choosing variable rate mortgages? Well, a lot of people in the comments are probably going to blame me and say it was all my fault. But the reality is the entire industry was telling people that they were probably safe in a variable rate mortgage, because when people were choosing their variable rate mortgages, they were doing it with the best information they had at the time. And the best information they had at the time was directly from the Bank of Canada, where they stated that Canadians could borrow money and expect that interest rates would stay low for a very, 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 very long time. In fact, here's the clip.
We recognize that Canadian businesses are facing an unusual amount of uncertainty. And so we have been unusually clear about the future path for interest rates. If you've got a mortgage, or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time.
So based on this information, financial advisors, bankers, mortgage brokers, mortgage specialists at banks all felt pretty confident that somebody could choose a variable rate mortgage and have a low interest rate for a long period of time. And in fact, when this information was communicated in the news and to consumers, consumers also felt that way because Tiff Macklem came out and said you don't have to worry about interest rates increasing for a very long time. So it was this information from the Bank of Canada that led many Canadians to choose variable rate mortgages. And by the way, it wasn't only the Bank of Canada, the Federal Reserve in the US also indicated that interest rates would stay low for a very, very long time. And the reality here is that nobody is at fault. The people who chose those mortgages, the consumers who chose mortgages, did so with the best information they had at the time. The people that gave them advice did so with the best information they had at the time. Nobody expected a ship to get stuck in the Suez Canal and China to have a zero COVID policy and Russia to invade Ukraine. All of these things led to higher levels of inflation, which led to the need for interest rates to go up faster. In fact, the Bank of Canada, the Federal Reserve in the US, they couldn't predict that those things would happen either. So I genuinely believe that when they gave that advice early on during the pandemic, that they believed that interest rates were going to remain low for a very, very long time. Now, the only mistake that they may have made here was providing forward guidance that they typically would not have made. Most of the time, central banks aren't going to give forward guidance with such certainty as Tiff Macklem and Jerome Powell did during the pandemic. But that certainty was needed. And it was needed because the economy, consumers needed to know that they were safe in making their buying and their borrowing decisions so that we could come out of the pandemic in a smooth fashion. Now, it just so happens that we came out in a smooth fashion. Things got really good really fast. In fact, they got so good that we ended up with a massive amount of demand and we have significantly higher costs on a lot of goods. Now, all that being said, there's a couple other things I need to point out here. First and foremost, there is a significant amount of mortgages in Canada that are hitting the trigger rate. So that means that payments are going to have to increase because people are now having interest payments that are higher than the amount of their actual fixed rate mortgage payments. Now, none of our clients at Mortgage 360 have variable rate mortgages that have fixed payments. They all have adjustable payment mortgages. That's because we always believed that it was better to have your payments adjust as interest rates went up. So most of our clients have already felt the pain and the pressure of increased interest rates, and they won't feel that pain and pressure as much as people who have variable rate mortgages with fixed payments. And for those of you who don't know, if you got a mortgage with a variable rate at a big bank that wasn't Scotiabank, you probably have a fixed payment, which means at some point in the near future, if the Bank of Canada continues to increase interest rates, you're going to face higher payments as you hit your trigger rate. And basically how this is going to happen is you're going to get a letter in the mail from your bank stating that your payment is about to increase. It's going to tell you how much it's going to increase, and then you're just going to have to deal with it. Now, for those people who have fixed rate mortgages, you're also going to have to deal with this when your mortgage comes up for renewal. But you have one advantage. You know exactly when that's going to happen, and that is on your renewal date. So pay attention to that. And if you have a fixed rate mortgage, make sure you're starting to make plans for higher payments now. And if you've got a variable rate mortgage with a fixed payment, make sure you're making plans if you haven't already hit your trigger rate for those payments to increase. Now, there are a couple of other interesting things to know. One has to do with stress levels. I thought this was quite interesting with respect to the rate of financial stress. It is significantly less right now than it was at the height of the pandemic. In fact, financial stress seems to be lower at the moment than it was prior to the pandemic, which tells us from an overall economy standpoint, we're probably still okay as long as the Bank of Canada doesn't increase interest rates substantially and put us into a place where we are feeling significantly more stress. But of all the data that came out this week, I think this is the most interesting number because a lot of people blame the higher prices of housing on flippers, people who are taking houses and making them better. In fact, the federal government just put some rules into place with respect to flippers. And it turns out that according to the Bank of Canada, the amount of people who are flipping homes, the share of flipped homes in Canada is a very, very small amount. In fact, it is under 1.25%. So for anyone out there who believes that house flipping has a significant role to play in rising real estate prices, it actually probably doesn't have that effect because home flippers tend to buy homes that people don't want to buy, that people don't want to live in because they are so dilapidated that nobody in their right mind would live in those properties. And then they turn those properties into properties that people can live in, which is actually a benefit to the real estate market and not a detriment. So I thought that was interesting data to point out as well. I think the Bank of Canada has to be really careful when it comes to saying that we don't have to worry about job losses because here's the thing, when it comes to job losses, when it comes to unemployment during a recession, it's one of those things that once it starts, it's very, very, very hard to pull it back. In fact, anytime we've seen an increase in unemployment, it goes up substantially, not just a little bit. So that's the key thing right now for the Bank of Canada is how do we make sure that people don't lose jobs? Because if they lose jobs, that's going to be where the real pain is felt. Forget higher mortgage payments. People can figure that part out. They've been borrowing at the stress test rate for several years now, and they've been qualified essentially at the rates that they're paying now if they have variable rate mortgages. So while I'm certainly hope that the Bank of Canada is right that the recession isn't going to be that bad and job losses aren't going to be that large, I also hope that these interest rate increases start to slow down. And by the way, if you are in the market for a mortgage in the next little while, maybe you have a renewal coming up or you are looking to dip your toes into the market, check the description below for my Rate Secrets course and my Homebuyer Masterclass, which will help you be more educated on the Canadian real estate system. And if you found this video useful, do me a favor, hit that subscribe button and check out this video on trigger rates.